record the video so that everyone, if you requested the video, I can be able, to send it to you and you can watch it. And again, there's a YouTube channel that all the videos that I'm doing right now, I do throw them on a YouTube channel. It's called the Daily Money Market. You can be able, to see all the videos, everything that I've been actually, teaching since the time. So you can be able to check everything from the Daily Money Market. When you have time, please check the Daily Money Market and subscribe. Ne? Okay. Okay. Oh, so you can hear me now. All right. All right. That's good.
Sell online and
that's good.
Business with Wix.
All right. So today, we prepared in terms of, a little bit of advanced risk management. For past couple of weeks, 3 weeks, 2 weeks, or a month ago, we've been talking about the normal risk management that we see in the market, right? We always understand that, if you want to trade, we have to at least put maybe stop loss, put the take profit, use maybe the pending orders, minimize your volume, which is the lot size, so that, bit by bit, you can be able, to minimize the risk that actually comes in the market, especially when a day like today, where there's a news, the biggest news in a calendar, in a forex calendar, which is NFP. So not only that, but again, 15 minutes ago, that was the New York session opening, right? There's too much volatility in the markets at particular time, so using those stop loss, using those take profit, the pending orders, they does help you to minimize in terms of you losing a lot of money, or again, in terms of you carried away with actually, just carried away with maybe with a trade to say that, okay, the trade is going on my direction, I'm making money, let me keep holding. You never know when the trade is going to be able to turn and you start losing the money that you've been making. So if you put a take profit, the trade can actually goes all the way and hit the take profit, then take the money that you actually, make in the market. They always say that, when you are trading, we shouldn't be greedy in the market. What it means is that we should have a target, right? How much we want to make, at particular trade, of course, or maybe at a particular, in a day, or in couple of days, in couple of trades. So if you know that, okay, I'm targeting this amount of money today, right? Kanjalo, bit by bit, day after day until the week finish. You're not going to have the greediness where you leave the trade and continues running. Eventually, when you check it again, you're out of market. So those are the things that I've been talking about for past couple of weeks, and doesn't mean that it's over. We're going to go back again to those, because what it matters in a forex market is to continuously do the same thing over and over and over again until we master it up, right? So today I wanted to touch a little bit of advanced, something way different than the stop loss and take profit, something that gives a little bit of heads away when you are trading, to understand what else can you implement on top of those stop loss, on top of those take profit, on top of pending orders, on top of having a targeted day, be patient, know how much you are risking. What else can you do to continue growing your account? All right. If you guys have any question, please stop me and ask immediately. If you wanna, say something, you can also jump in and comment. There's no problem at all. All right. So before we jump in and start, actually, I wanted us to go through in terms of the numbers. These are the numbers for estimation of NFP. So NFP started at 2:30, which is, it wasn't that much positive, but I want you guys to understand the reason why it was not that positive, right? So this is the presentation I created before the NFP numbers come out. Right now, the NFP numbers, they come out, and then you're gonna see the difference from the previous, from how they were, you know, how before the numbers, how they were estimating, until up to, you know, what numbers did they bring on at the present. So the NFP estimation was 320,000 employment that actually gonna bring. Eventually, the previous month, previous numbers, which is May, it was 428,000 that they were estimated, and they actually reached. And again, there was a little bit of news saying that Biden keeps the numbers flowing to auto car manufacturing. So they actually, President of the United States pumping in money on an industry of auto manufacturing cars, right? Because of the way they, you know, the world is going these days. People, they want the auto cars, electronic cars that they can, you know, drive without maybe putting fuel. Fuel is becoming expensive. So the cars that drives with electronics, you know, the cars that you charge is becoming much more better to be able to use. So the whole cabinet of the United States decided to pump so much money in a manufacturing of those auto car industry. So 6% growth in terms of GDP from last month. And employment rate in terms of last month, it was 3.6%. And again, the second quarter this is the second quarter, the end of the second quarter, inflation rate dropped to 7% to 8%. And the biggest news that comes today that a lot of people, they were talking about, it's Elon Musk says that Tesla will cut the staff by 10% rate. So they want to cut the staff who work at Tesla by 10%. But remember, the cabinet of the United States, they pump up money in the manufacturing of auto manufacturing cars. And Tesla, it's one of the company for auto manufacturing cars. So if Tesla is cutting the staff, cutting members for 10%, it means the job itself in the United States, a decline. So this is the reason why you can see everything now, it's on red. You look at the NASDAQ, it's falling. You look at the dollar index, it's in red. You look at S&P 500, it's falling because of the job itself. It's actually dropping. Companies that produce the best industry right now, side, they're actually willing to, to cut down the jobs to 10%. So these are basically estimation about the NFP. If you want to read NFP, you need to understand numbers like this before the NFP happens. So it's not all about the direction where the NFP is going, but also what are the numbers? What did the numbers talk before the actually NFP, started? All right, before we jump further, any questions so far? We good? All right. So in terms of our advanced risk management, the most important part that we look at on advanced risk management is correlations and risk management. So we need to understand what is correlations. What does it mean? What instrument does actually, have the positive correlations and the negative correlations? How does correlation affect us when we are actually, trading in a market, right? If you don't understand, please stop me immediately so that we can, break down much more further. So the market correlations is a measure of how much asset move in a line with each other, right? What asset does it move with another asset? If let's say a beans, the price of beans is growing up, does the price of wheat also grow? If it grows together, if beans are growing and the wheat are growing, that means the beans and wheat, they are correlation commodities. So this is what we are talking about, right? We need to understand the pair, the instrument or the pair that actually goes with another instrument that goes positively. If they go together, if they say one instrument is buying and another instrument also it's buying, right? That's a positive correlations, right? Now we need to know what type of instrument are that. Now there's a positive, a negative correlations where when one instrument is buying, the another instrument, it has to sell immediately, no matter what. Those are called the negative correlations. So these are also a type of strategy that you can learn if you know that if I trade Euro USD, that means GBP Euro is dropping. If it's buying this one definitely is dropping. Then you can go, you know, to that instrument and trade that instrument. Or then you can say that, okay, let me not focus to this instrument. Let me focus on this type of instrument. That's what we are engaging today. So you can measure the correlations of a specific market, industries, or entire asset classes. Correlation is usually measured as a percentage. If two markets are 100% correlated, then their movement will always be the same, right? If they are 100% correlated, their movement will always be on the same. When one rises, so will the other. This is called a perfect correlation. This is called a positive correlations. Are we together there? Are we together? So far, so good, right? All right. Once more, thanks very much for people that are tuning in. Thanks very much. I can see Anisha, Dion, Mr. Ditlak is there, Tomisani, Joe, you know, all the guys, Sango, Nkosnati. So yeah, appreciate it for tuning in, guys. Any question again, stop me and then let me know or type on a chat. So this is one of the examples of correlations. These are perfect correlations, or we can say a positive correlations, right? The FTSE 100 and the FTSE CFD should have 100% correlation. For example, because the FTSE CFD will always mimic the price movement of its underlying of the market. Okay, let me break down again. The FTSE 100, right? So the FTSE 100, it's actually a stock that is listed in the London Stock Exchange. So there's 100 companies listed under the FTSE, but it's based on London Stock Exchange. So this FTSE 100, it's a stock in a way that if you buying a stock, for example, if you are trading a stock, you buy a stock at a price of 100, and then when you get to the price of 200, you sell it. Now you make the difference, the dividends of it. That's what you make. If you buy it on 100 and then you sell it on 200, you make a profit of 100. That's a stock. Remember, guys, that's the stock market, right? It's not the CFD market. That's a stock market. Now, when it comes to the CFD's market, a CFD market, CFD, it means a contract of a difference. So it means if you buy at 100, right? If you open a trade at 100 and now you closing it at 200, you only make the difference from point A to point B. So you are not selling at 200 so that you can collect it, so that you can sell it in a higher price, but you only make the difference of it. So I think that's a first point that we should understand and know it, the difference between stocks and the CFDs. What we trade between you and me, we trade CFDs. Everything that we see in a market, they are CFDs. They are contract of a difference. We are actually trading from the point A to point B. The money that we make is the difference. It's the one that been calculated moving by the points. Point number 1, point number 2, point number 3, point number 4, until you get to the closing price. So from the opening price to the closing price. So if you look at, let's say you look at a FTSE 100 on a stock exchange, right? And you see the price of FTSE 100 on a stock exchange, and now you realize that, okay, let me go look at CFD, right? Let me go look at CFDs. So you jump in and you go look at the CFD and you realize that these are correlations. These are moving along together, right? And this is most important. It's very, very important to understand the product that move along, because of to avoid to say that, okay, I'm selling the CFD, but you have realized that, you know, the stock itself, it's actually, you know, making going on another direction. Okay, any questions so far at this point? Did we understand the reason why it says the CFD, the FTSE CFD will always mimic the price movement of its underlying market? Do we get it there? What does it mean, if I may ask a question to anyone? What does it mean, if I may ask a question to anyone, that says the FTSE 100 CFD, it will always mimic the price movement of the underlying market, which is the FTSE 100 stocks? Is there anyone? I just explained. Is there anyone who can give me the same explanation that I just said? Mr. Tumisan, Dion. Okay, cool. So what it means is that, think about, you see a stock, if the price of stock is 100 Rand, let's say the FTSE 100, the price is just 100 Rand, right? Now, if you are buying or selling stocks, what it means is that you're going to, if you buy at 100 Rand and you sell it at 200, so you made a difference of 100, which is the profit, right? And then that's done. But the moment that the stock start going up, increasing, building up to 110, 120, 130, 140, 150 to 200, right? That's actually feeding the price to CFDs, the one that you and me, we trade. So the more it's growing up, the more now the price movement at the CFD starting changing, starting growing all the way up again, right? Moving in a percentage way. Remember, on a CFD, it's calculated in a percentage way. So it starts moving in a percentage way. Percentage, 1%, 2%, 3%. Then it will be multiplied, of course, by actually, you know, the load size that you actually, you know, use. If you use 0.01 or use 0.02 or use 0.03, that's actually how much money you're going to be able to make. Okay, all right. I can see that no one want to ask, you know, questions. Let's move on. Let's move on. Hey, what's going on here? Okay. Yeah, we're here. So just a little bit of breakdown as well. A 50% correlation, meanwhile, it means that the two markets generally move in the same direction, but may not always follow each other on their lockstep. So it means 50% correlation, it means they're moving on the same direction. When it's buy, but the points is not the same. So the other instrument, it will be a little bit higher, maybe moving a little bit faster. The other instrument, it will be moving a little bit slow. So the other will follow. They don't go accordingly together like 100% correlation. So the other one will actually follow when the one instrument is actually going up, right? So stocks in the same sector may also show a very highly correlation rate, which can make it difficult to find a share that outperforming in peers. For example, peers are also often highly correlation, especially when their futures, the US dollar, when they actually future the United States dollar. Okay. So far, so good. Okay. So these are types of correlations that we can get in a market. I hope everyone can see. Everyone can see and can hear. These are types of correlations. We have, there are 3 types of correlations that you can get in a market. You can get a positive correlations, describe the markets that mimic each other movement, like the FTSE stocks to the FTSE 100 CFDs, right? It mimic, it's talk about the other instrument, right? Then there's a negative correlation, describes the markets with inverse movement, All right, Mr. Shadrach. All right. No, don't worry, Mr. Shadrach, you'll be able to understand because we just started again. We're not that far. So pretty much, Mr. Shadrach, correlations, it's actually a product that actually goes along or goes, a different way. So on a correlations, there's a positive correlations, there's a negative correlations, and there's again a normal, correlation. So you can find the strong correlations because of how they move to each other. So the reason why we are having this conversation, it's actually the topic is advanced risk trading strategy that you can understand. The reason why is that you should be able to top up on top of only on top of the risk management that you use, like a stop loss, take profits, pending orders, know how much lot size you need to use, how much risk you need to expose in your market. On top of that, you can also understand in terms of correlations, what instrument does it collide with another? Which instrument does it move with another? So basically that's what we're talking about. And you actually find us when we're breaking down in terms of the types of the correlations that we can find in a market. So we said you can find a positive correlations, describe the market that mimic each other, the market that actually talk about the other market when in terms of the movement, right? Then you can find the negative correlations, describe the market with inverse, the one that reverse the movement pattern. So the other one is going this side, this one it's inverted against the instrument. Then you can find no correlation, describes a market with no relationship whatsoever at all. Those are things that you can find. Ladies and gentlemen, as always, the presentation, the Zoom will cut in 10 minutes. So please, right now we left with 9 minutes, 30 seconds. Let's join again. There's a lot of that you should understand. There's actually, in terms of instrument, a pair versus a pair, showing you which one does it go along. So you can see here 60% to 100% is strong negatively correlation, 20% to 60% is slightly negative correlated, 20 to 20% essentially uncorrelated, 20 to 60% slightly correlated, 60 to 100% it's actually strongly correlated. Okay, why correlations are important? So now we need to understand why these correlations that we're talking about, they are actually, important in a market. So the correlations can have a significant impact on your overall risk level and your bottom line. Briefly, is because they act against a diversification of the account. So when you try to divest your portfolio, yes, question, sir?
Yeah, I'm not sure about those. Go back to that earlier slide, the slide that you've just left now.
The slide that I just left.
Yeah.
This one.
Yeah, yeah. May you please slowly explain the strongly negatively correlated and the slightly negatively correlated, because I'm not sure what makes the difference here.
Okay, all right. Bear with me, sir. There's another slide that actually says why this instrument and this instrument, they are correlated. Why they are 60% and 20%. So there's a slide that is coming that has that type of information. But pretty much when we talk about a strongly, let's say, negative correlated, it's actually the instrument that goes opposite way. Let's say this instrument deals with maybe manufacturing companies. Then you find another index that deals with technology, companies, right? So those are really negatively, because manufacturing and technology, maybe it won't go along, right? But to find out, you might find out maybe they are actually slightly negative correlations, because maybe you might find there's a companies that deals with the manufacturing, but that need technology for them to actually, continue with their business. So that's what basically mean the instrument that you are trading, does it have impact to another instrument? Does it actually impact the other instrument in a positive way or in a negative way? But we're gonna get that. Thank you for the question. All right, so we're talking about the reason why these correlations are important. So for example, if you have opened a short position or two market with a 75% positive correlation, then it is probably that a bear trend in one will lead to the same move in the other, right? In this case, you are risk losing the capital of allocated to both position if one moves against you. So you totally risk from the trade could be higher than you originally planned, right? So if one trade, two trades, two instruments, they are all moved to each other. But when you are actually, analyzing, maybe they have 75 positivity correlation. And then when you execute a trade, you actually, buy the other one and the other one itself, you sell. So you find out that you're still losing in a market while, you buy this into the other one you bought, the other one you sell, because of these as same correlation, they go along, they complement to each other, right? So just in order, just to know this type of instrument and the reason why, it's knowledge enough to actually, go in the market and select a perfect instrument to trade at that particular time. 4 minutes to go, still have 4 minutes, then please let's tune in again. If you have a multiple correlated position, then your overall risk on a portfolio level could be far higher than you think. So it's always worth researching with the markets are related and which can add your diversification of the portfolio. All right, so the profiting from correlation, how do you profiting from this same instrument talking to each other? You can also use the correlations to target the profits. One stock trading strategy, for example, involves finding correlated companies and monitoring their price action. If one stock diverges from the rest, you can take a position on its eventual return to the normal, right? So it means if you see NASDAQ and the US 30, they move along, right? And you are actually looking at a NASDAQ, you buy NASDAQ, right? And it's buy, right? Immediately when the NASDAQ turns, you already know that US 30 also is dropping. So even if you have this instrument, you are losing, maybe you're losing $200 on a NASDAQ, right? And now the market is turning, you want to recover, you can jump to US 30 to say that, let me go on this direction, right? You open a trade, for example, one NASDAQ, you buy or you are selling, you do whatever you do, and then eventually you come, you find the market turns, it doesn't go on your direction, it goes oppositely. Now you are losing the money. But eventually, for the fact that you know that NASDAQ goes along with the US 30, so you jump in on the US 30, execute a trade, recover what you are losing on a NASDAQ. I don't know if it makes sense. If you understand that the dollar index and gold, they are not positive correlation, they are negative correlations, right? A dollar and a gold, they don't feed to each other. They are all strong currencies. So if you can see the dollar getting stronger and you are trading maybe USD JPY or USD ZAR and the dollar is getting stronger, and then eventually you start losing, you can go to gold and recover from gold and execute a trade in gold and trade and try to recover from those losses that you get from other instruments. Volatility can have an impact on correlations. In times of the higher volatility, the market tends to become more correlated, which may increase your overall risk, right? So the market tends to be much more similar during the higher movements of the market. So these are during maybe the NFP, maybe during the open session, or the opening sessions of the session, maybe New York session or London session or Tokyo session or a Sydney session, right? You can finally see mostly or notice most correlation instrument, that this instrument, they actually move along. All right, guys, any questions so far? All right, so far so good. A minute, guys, a minute left. It's gonna cut any time from now. All right, so a few key market correlation. Some correlation are only temporary, others have lasted for years and it looks set to continue, right? Here are some of the common examples that we can see as the correlation, okay, that we can see. Here, the example, be aware of your trading as well. So this is one of the example, USD versus gold. This is what I was actually, explaining to you earlier on. Perhaps the best non-correlation of all time, is between the US dollar and gold. Gold is priced in the US dollar. So its price is hugely dependent on the strength of currency. When US dollar rise, the gold